Imagine two investors both put money into the exact same index fund on the exact same day. One starts with $4,160. The other starts with $7,290. Same market, same fund, same risk after the contribution. But before the market has moved even one tick, the second investor is already up 50% on their own dollars. That is the strange math of a 401k employer match. It is often described as free money, which is emotionally true but mathematically incomplete. A better way to see it is this. The match changes your starting price before investment risk begins. In one common plan design, an employer matches 50 cents for every dollar you contribute on the first 6% of pay you contribute. On a $81,000 salary, a 6% contribution is $4,160. The employer adds $2,430. Your account begins at $7,290 before the market return is positive, negative, or anything in between. This video is not financial advice. It is a model of one specific mechanism, why an employer match can beat almost any normal investment return, and why the guarantee is real only after we account for plan rules, vesting, taxes, liquidity, and access. To make the math precise, we need 4 variables. Let S be salary. Let D be the employee contribution rate. Let H be the percentage of salary that is eligible for the match. And let M be the employer match rate on each eligible dollar. The important part is the minimum function. The match grows only until the cap. After that, additional contributions may still be useful for other reasons, but they do not receive more matching dollars under that formula. If D is less than or equal to H, every dollar you contribute is matched at rate M. A 50% match means an immediate 50% return on your contributed dollars. A 100% match means an immediate 100% return. If D is above H, the total match stays capped, so the match return on all contributed dollars declines. That is why the shape is a kinked curve, not a straight line forever. For example, with a 50% match on the first 6% of salary, contributing 6% gives a 3% of salary match. If you contribute 10%, the match is still 3% of salary. The match return on all contributed dollars falls to 30%. This is not an argument against contributing more. It is a way of identifying where the match itself stops. Actual plans vary. Vanguard reports that among plans offering a match, 68% of plans used a single-tier matching formula in 2024. A common example is 50 cents per dollar on the first 6% of pay. The most common specific formula in Vanguard record-kept plans was exactly that, 50% on the first 6% of pay, used by 13% of matching plans. Now watch how much the instant return changes when the formula changes. The first plan gives 50% on the matched dollars. The second gives 100%. The third gives 80% if you contribute enough to capture the full formula. This is why saying, "My employer has a match," is not enough. The return is hidden inside the formula. Now compare that with market returns. NYU. Stern historical data show that $100 invested in the S&P 500 at the start of 1928 grew to $982,817.82 by year-end 2024, including dividends. That is about 9.94% annualized over 97 years. That is a powerful long-run return, but it is not immediate. It is volatile. It arrives through decades of gains, crashes, recoveries, dividends, inflation regimes, and valuation cycles. At that historical annualized rate, it takes about 4.3 years to compound to a 50% return. It takes about 7.3 years to double. A 50% match is not better because it predicts a higher market return. It is better because it is not a market return at all. It is a rule-based deposit from the employer, credited before the investment outcome begins. This comparison is not saying the S&P 500 will return 9.94% in the future. It is saying that even one of the strongest long-run asset classes in modern financial history needs years to replicate what a match can do instantly on the matched portion. The match does not eliminate market risk. It creates a cushion before market risk begins. For a 50% match, the break-even market return is negative 33.3%. That means if the account receives the full match and the market immediately drops by 30%, the account can still be above the employee contribution amount before taxes, fees, and vesting complications. Using our $81,000 example, the employee contributes $4,860. The employer adds $2,430. The starting account value is $7,290. If the market falls 30%, the account becomes $5,103. That is still $243 above the original employee contribution. If the market falls 40%, the account value falls below the employee contribution amount. So the match is not a magical guarantee of final value. It is a guaranteed uplift to the starting value, conditional on receiving and keeping the match. A 100% match creates a 50% break-even cushion. An 80% match creates a 44.4% cushion. This is the geometry of the match. The larger the upfront deposit, the more market loss is required to erase it. The surprising part is not that the match is valuable. The surprising part is that many people still miss some or all of it. A 2024 research paper by Vanguard, Yale, and MIT studied 8,497 plan years from 2013 through 2022. In their sample, 22% of workers did not participate even though a match was available. Another 24% contributed below the match cap. Only 13% contributed exactly at the cap, while 41% contributed above it. So in that sample, 46% missed at least some of the available match, either by not participating or by contributing below the cap. But this is where the story needs to stay human. Missing the match is not always irrational. It can reflect low income, high rent, debt payments, medical bills, job instability, confusing enrollment design, or simply not knowing the formula. The same research finds that less than 20% of workers contribute exactly at the maximum match level across the income distribution. Lower income workers are more likely not to participate. Higher income workers are more likely to save above the cap. That means the match is mathematically simple, but behaviorally uneven. The strongest return on paper is still missed when cash flow, complexity, and access get in the way. The word guaranteed is powerful, but it needs footnotes. The clean statement is not. Every 401k match is risk-free money in every situation. The clean statement is when you are eligible, when the match is vested or likely to vest, and when the plan fits your liquidity constraints. The employer match is a rare return that arrives before market risk. First, access. The Bureau of Labor Statistics reported that retirement benefits were available to 72% of private industry workers in March 2025, and 70% had access to defined contribution plans. That leaves workers without access, especially in smaller establishments. Second, eligibility. In Vanguard data, 65% of plans offered immediate eligibility for matching contributions in 2024, representing 57% of participants. Many plans are immediate. Some are not. Third, vesting. Your own employee deferrals are always yours, but employer contributions can vest over time. IRS rules generally allow employer contribution schedules as slow as a 3-year cliff or a 6-year graded schedule, though plans can vest faster. Vanguard reports that nearly half of plans with matching contributions provided immediate vesting, while about 1 in 4 used 5- or 6-year graded vesting. This matters because an unvested match can disappear if you leave before the schedule is complete. In that case, the arithmetic return was promised, but not fully kept. Fourth, liquidity. Money inside a retirement plan is not the same as money in a checking account. The IRS says most retirement plan distributions are subject to income tax, and early distributions before age 59 and a half generally trigger an additional 10% tax unless an exception applies. Fifth, fees and plan quality. Fees do not usually erase a 50% match, but they still matter over decades. The Investment Company Institute reports that 401k participants investing in equity mutual funds paid an average 0.26% expense ratio in 2024, and target date mutual funds averaged 0.29%. Some plans are cheaper, some are more expensive. The point is to check the actual plan. The match is immediate, but the consequence compounds because the matched dollars can remain invested. Keep the example simple. Salary stays fixed at $81,000. The employee contributes 6% per year, or $4,460. The employer matches 50% on that amount, or $2,430. For the future value calculation, treat deposits as end-of-year annual deposits. Ignore salary growth, inflation, taxes, and job changes. This is not a forecast. It is a controlled math experiment. At a 0% investment return, after 30 years, the employee-only account receives $145,800. The matched account receives $218,700. The difference is $72,900, exactly the employer contributions. Now add a hypothetical 7% annual investment return. The employee-only contribution stream grows to about $459,079. The matched contribution stream grows to about $688,619. The difference is about $229,540. Notice what did and did not happen. The match did not improve the investment return of the fund. The same 7% assumption was applied to both accounts. The match improved the contribution base. The compounding engine had more fuel. The employer match is one of the few places in finance where the math is both simple and unusually powerful. A 50% match is not a stock pick. It is not a timing signal. It is not a secret fund. It is a plan rule that can turn $1 into $1.50 before the market has any chance to help or hurt you. But the right question is not just, does my employer match? The right question is, what is the exact formula? Where does the match cap stop? When does it vest? When is it deposited? What are the fees? And what liquidity trade-off am I accepting? Once those questions are answered, the match becomes visible in the only language markets truly understand, starting value. And starting value matters because every investment path begins from there. This video is for education only, not financial, tax, or legal advice. For any real plan, the source of truth is the plan document, the summary plan description, and qualified professional guidance where needed.